Hello and welcome to the Monday Futures Market Outlook for April 22nd, 2013. This is Patrick Serezna. We wanted to let all our listeners know that we have a free webinar, special webinar coming up on April 24th on the Wednesday at 8 p.m. The topic being, is your money safe in your bank account? We go into a little bit of detail about the Canada Action Plan for 2013 and the bail-in clauses and what's going on in Europe and other topics like this. If you're interested in attending, please visit the Learn to Trade Global website. Registration is on the homepage. As always, we start off with the chart of the U.S. dollar index futures, and we were looking for the U.S. dollar to have some sort of a correction over the last couple of weeks, and we certainly have seen it as we've now saw the U.S. dollar gravitate down toward that 81.5 focal point where we were looking for the support for the buying opportunity. If in fact that was that short-term bottom, it'll depend a lot on what the euro does in the next few days and weeks. But if that was the bottom, there's now room for the U.S. dollar to rally even as high as that 85 level where the highs from the summer of last year were. And so we remain optimistic on the upside of the U.S. dollar. Next year, I want to take a look at the euro, and what's in store for the euro is going to be certainly discovered this week. We're at a major critical stage here at the 130 level. If the bulls want to keep the party going, they will need to hold this kind of 130 area and then push it back up to 132 and 133 on the upside. But if we have any material price break below 130, it really does open the window for potential further deterioration in the euro, which would allow the U.S. dollar to strengthen substantially. We're going to be watching this euro for the big tell. If the euro began to drop below 130 with any real momentum, that really does open the floor not only to a retest of the 127.50, but rather the beginning of a whole new leg lower in the euro. So this is going to be very interesting to see what develops here. Next year, I want to take a look at the 30-year Treasury bond, and the Treasury bonds have continued to strengthen up toward the highs of last year. Even the 10-year Treasury bond has broken to new highs. While this is overhead resistance and should initially stall the 30-year Treasury bonds up along these highs, we do want to identify that there is the potential for a material breakout on the upside. And while we don't want to be suggesting anyone be buying bonds right into overhead resistance, we'll be watching whether the price action remains relatively strong going into there and whether or not it could follow through. If we do have a break to higher highs, there is room for even 153, 155 on the upside on the 30-year. Next year, I want to take a look at copper futures, and copper prices have actually been quite substantially deteriorating. Copper hasn't been immune from the drops that we've seen in markets like gold and silver and other commodities. At this juncture, with this breakdown in copper, we do, while it's already getting quite oversold, there is room for it to drop all the way down toward the $3 area. At some point, we will get a bounce, but this is a very meaningful breakdown that is not going to turn around and become bullish in a short window of time. We anticipate that once a short-term low is put in, we'll have a bounce very similar to the way we're seeing currently in the gold markets, but it is very likely that any rally by copper will find substantial overhead resistance now at that 335 level. And so we probably are going to spend many months trading between the $3 to $3.35 area until copper finds proper bottoms and does a proper bottoming formation from where we'll see where the next substantial opportunity lay. Next year, I want to take a look at crude oil, and crude oil has also deteriorated down to a major support line. We do believe that there's actually vulnerability of crude to even break down one more time, but this is going to be a place where a lot of traders are going to try to initially hold the support and see whether or not this is where the bottom in crude will develop. At this stage, we'll watch these previous lows here around this 86, 87 level bounce back to $90, $92 on crude. Would it be a very natural process process. It would not really change anything in the bigger picture. But if at some stage this week or over the upcoming weeks we have any legitimate breakdown below this 87 kind of area where we marked our focal point, really it would open the window for another even $6-7 lower down towards $80 a barrel. So especially if that's coming in an environment where we have a weak euro and a very strong US dollar. So keep your eyes out for that correlation. Next year, that brings me to looking at gold futures. And obviously, when the 1550 level gave out on gold the other week, it led to one of the biggest crashes in gold prices that we have witnessed at any point from a price perspective. At this juncture, we are getting the dead cat bounce here. We were suggesting that once it stabilized, we'd see 1450 to 1500 on the bounce, and that's where we're probably heading here. That doesn't make us bullish at this point on gold. We were trying to be optimistically bullish back along the previous support lines, but when this level broke, we've got a new dynamic that we have to take into consideration. It is likely that once we see strength back to 1450, 1500, that gold will likely be distributed again, and we will probably have to come to do some sort of key retest of the lows. Well, that may come in the form of a double bottom. It may come in even a test of 1300, but it doesn't even have to go back down to those lows. But the one thing I would really suggest at this stage is that gold is likely to be somewhere down in these bottom ranges for a month or more before something much more meaningful can occur. So right now, a short-lived rally of even another $50 an ounce on the upside, it could actually occur, but then subsequently that rally being faded would be a very natural occurrence. Finally, I want to take a look at the S&P 500, and really at this stage, even though the market mustered up an impressive rally all the way up to 1580 during that little squeeze after the jobs numbers, we really have been going through a corrective phase. Really at this stage, this is likely the area of a topping formation that we can more or less suggest has been going on throughout much of March into April. At this stage, with this morning's rally, there's a chance that we could even see rallies back to 1570, 1580 on the upside for retests. But it is far more likely here that a topping formation is developing, one which could have the S&P 500 correct as deeply as 1450, and even a very small chance that there could be a crash. But we never like to put a high probability on forecasting that kind of a scenario. But at minimum, we're probably going to see markets throw back into a proper correction that will allow the next substantial buy on dip opportunity. So at this stage, we remain out of the markets and continue to wait when the correction will represent the next buy on dip opportunity for our listeners. Just to review our key intermarket observations, we now changed our short-term risk-reward on the U.S. dollar to good. We'll find out whether that was preemptive or early enough or not, but we do believe that there is room for the U.S. dollar to continue to strengthen. Particularly, we are suggesting that everyone watch the euro, because the euro is the largest component of the dollar index, and if we see that euro break down below 130, that could be the driving catalyst for a substantial move higher in the U.S. dollar. In the commodities remain in a downtrend, but we find it hard to justify from a risk-reward perspective that it's a poor proposition at this stage. While the commodities can still weaken, we're far closer to the bottom end of the range than the top, and therefore we want to stay relatively neutral and respect the downtrend that's in place. In terms of bonds, we are still considering it range bound from a longer term trend from that sideways consolidation, but we still believe that there is room for bonds to have be able to strengthen, and particularly if they break to new highs on the 30-year. And nonetheless, while we do have that good in there, and while we do believe that our members can be in bonds here, we do want to just make sure that everyone uses dips to buy rather than chasing bond markets higher. When it comes to the stock markets, we've now changed our on global stocks the long-term trend to being range bound, as we've now seen most global marketplaces be in the midst of a good correction. Only the U.S. markets really remain in uptrend very distinctly. Both of them still represent poor risk-reward propositions, but a market correction can last as little as 4 weeks, so it could be even a month's time where we're already switching now from a poor proposition to a good one if we get a good correction that gives us that opportunity to buy on dip. That was your Monday Futures Market Outlook. Thank you for joining me.